Good morning, REC Nation.
We are live on Facebook. I'm not sure if the team got us live on YouTube, but if you're watching live on YouTube and or Facebook, welcome to Brunch with REC. Simos, can you believe this, my man? We are up to like 20 brunches now that we've done.
Listen, man, brunches were are the child, and they are the outcome of COVID. So this would have never happened, and this, to me, this just shows and proves that everything on this planet, everything in your life happens for a reason. This all started. Good morning, Ken from Ottawa, Dino from Waterloo. Good morning, everyone.
As always, keep letting us know where you're signing in from. We'd love to see where people.
But REC brunches are the love child of COVID. It was a necessary means at a time when we were all scared, stressed, and shook to communicate and get together and share thoughts, kind of maintain our momentum and as investors have something to talk about and try to make sense of it all.
I couldn't agree more, buddy. I couldn't agree more.
And here we are, Jazzy, 9 months later, legit. It was, I think, the first week of April or last week of March when we got started, whatever the hell it was. But time passed, brunches grew. We literally have over 200 to 300 investors log on from all over Canada every single time. Some of these brunches had nearly 1,000 people on, depending on the time and topics and how much it hits home and everything else. So a massive thank you to every guest we've had, a massive thank you to every single person who chooses to be with us and spend their time with us. And I want you to give
hang on 1 second, Simo. Somebody's on their honeymoon, I believe. Well, just a big congrats. I think I saw this.
Married to real estate, baby. Married to real estate.
Congratulations, whoever. Yes, I see. It's Camilo on the honeymoon. Congratulations and thank you for spending part of your honeymoon with us and with REC. You're part of the REC family. We can't wait to meet you guys face to face. I also, Simos, I mean, you were thanking all the guests that came on, all the attendees. I also wanted to take a second to thank everyone that's watching the replay of this brunch. And so if you have to sometimes jump off, we understand. That's okay. You log back on, you log off. But to always see the full recording, all you got to do is go to REC Canada's YouTube page, and the full recordings of all our past brunches are there, including this one as well. And so if you're watching the replay, thank you. We would love to have you live every other Saturday because we do an awesome Q&A at the end of every brunch, and today's going to be no different. In fact, you mentioned topics, Simos. It's why I think we had a little over 500 people register for this brunch this week, because we're going to be talking financing. We're going to be talking how to acquire capital, how to find down payments, with none other than Mr. Chris De Souza from Sherwood Mortgage Group. How you doing, Chris?
What's up, Jazzy boy, my man? How are you?
We are amazing, buddy. Look, you and I and Simos and REC all together, we've been doing business and helping investors, first-time buyers, move-ups, buyers and sellers as well, but mostly investors for the last 15 years with acquiring financing. And so we thought, what better time than nearing the end of the year to have this conversation? So we're going to touch on a few things today. We're going to touch on, if you're a new investor watching this and you have no idea about the financing process, you're hearing about all these rate changes, Bank of Canada, what's going on with variable and fixed, we're going to talk to you today. We're also going to speak to the group of people that have 0 to 5 properties in their portfolio now. You're what we call a seasoned investor. And so financing changes from 0 to 5 properties. Then the third group of people that we want to talk to are veterans, like the guys and gals that are like, they can do this brunch on their own if they wanted to. When you have 5 properties and more, now financing gets definitely gets tougher, but not impossible. A lot of people, because they walk into a bank, they hear that well, oh, you have 5 properties or more, we can't finance you. It's why we always discuss, Simos, you do this very, very well with our team as well as our clients, where you talk about, and we talk about, the importance of working with an independent mortgage broker.
Yes.
Right?
Yes.
Making sure that you understand that the banks, they're not a nonprofit organization. So the red bank is not going to talk about the green bank, and the green bank's not going to talk about the blue bank, and so on and so forth. And so working with an independent mortgage broker, they have access to hundreds upon hundreds of lenders that even Simos and I, being in the real estate business for 15 years, we don't even know half of these guys and gals. So Simos, why don't you just touch on that as well, my man?
Yeah. So first and foremost, welcome to REC Brunch, Chris. We're so happy and honored to have you. And as Jas said, we have a very long working relationship. We've literally done, I would say at this point, thousands of deals together, legit. So for as far as anyone in the audience is concerned, Chris is not the only broker that we work with, but Chris is definitely probably the longest running broker on our roster, who has, and I'm not saying this for nothing, it's Chris above and beyond being a tremendous friend, from a capacity and work ethic and getting the job done. Unless you can do the job that you promised and signed on to do, you're not going to be on this roster. Just like us, any member in the audience who comes to us to transact, to get advice, to consult, to do what they need to do. If we can't do the job, they won't be here. So Chris has been doing a relentless, incredible job for us for a very long time. And the reason I'm saying this is not to plug Chris, it's to plug work ethic, commitment to the craft. And at this point, with thousands of deals under your belt, I think I'm establishing credibility in what you have to say. So I want the audience to truly pay close attention to some of the strategies that he's going to share, because just like us, we don't hide the secret sauce. There is no secret sauce. We're going to share exactly what we do.
That's why we wrote the book on it. How to buy on your own, how to sell on your own, how to invest on your own. There's no cost for this. If you have not received this book yet, just send us an email at info@REC Canada and let us know that you want a book. But we're also going to be speaking about how you're going to be able to get in touch with Chris. And we think it's very important that you do it during this time of the month of December, just before the 2021st, in my opinion. Why? Because we find over the years that most investors start to put their feet up because it's starting to get cold outside. But the best deals are found during this time, because if a seller has a property for sale right now, they're allowing people to walk in, A, because of COVID, but B, just like get all that slush in their homes. You know that that they're quite motivated. So there's a great, not even a great opportunity possibly that you can take advantage of. But before you actually even go out shopping, you need to know what you're qualified for. How are you going to get the financing? Fixed versus variable. What's going to be your rates? What's going to be your cost of borrowing? So, Chris, can we just high level for a sec talk about, at the time of this recording, we're December 4th or something like that today, or 5th, I apologize. What's going on with interest rates right now? What's happening? What can somebody get a fixed rate for? What can somebody get a variable rate for?
Oh, and I want you to pinch yourself first too.
Rates are low, Jazzy, as we all know. They're extremely low, variable and fixed. The spread between the two is very close to each other. It does come down to strategy. I always like to say and think, with my own portfolio, that variable does always win, but it also depends on the risk, right? Everyone has their own risk tolerance around on fixed and variable, and some people have to lock in for that 5 years, because I may not be able to do anything for them for the next 5 years anyways. So
now, when you say you might not be able to do something for them for the next 5 years, what do you mean? Just elaborate on that for a second.
In terms of if they need to be able to hold on to their property, they need to keep it for 5 years. First-time investors are very similar to the first-time home buyer, if you want to call it. There's an educational piece around it from start to end. You're buying your first home as your principal residence to get into the market, to get outside of renting or to move out from home. But as a first-time investor, it's what do you do in terms of rates, like you're asking, and do you go on a variable, do you go on a fixed? And that's what I do. I map it all out for you, and I tell you exactly where you are today, where you need to be in 3 years, what your 5-year goal is, and what do you do at that 7-year mark in order to complete your transaction from start to end.
Now, we might have somebody who's watching right now that's actually like in the process of doing a deal. And so I want to bring them some value. What are you seeing? And we won't quote you on it. It's only us. We're not even recording it. I'm kidding. We are recording it. And there's hundreds of people watching. But what are you seeing from a fixed? Like what is a range for a fixed rate for 5 years? And then what's a variable rate? And I know you mentioned the spread's not that big, but I actually want to make sure that we give some type of value in that sense.
Sure. But let's be a little bit more specific. We're talking investors. We're talking investing on rental properties. There's always a premium on the rate on a rental property. And that's always going to be in range between 10 to 15 basis points. So on a rental, depending on the lender, we can get between 2.09, 2.19. There's that prime plus 15 points that.
Chris, I'm just going to stop you. To everyone listening, the reason there will always be a premium on a rental property is because it's risk-based. Owner-occupied, so if you were just think of logical risk, if you live in a home and you were to miss a mortgage, would you miss the mortgage of the home that you live in, or would you miss the mortgage of your investment property first? So if everyone can just use that as a benchmark, understand why every time, no matter what, an investment property is going to have a premium. Continue, Chris.
Absolutely. And that premium ranges based on the lenders that we go to as well. And when I draw out that financial blueprint for all of the investors, it's where are they today? How much what does that rate look like? And how do we grow their portfolio to help them achieve their goals in purchasing multiple properties? And that takes time. In any business, in any relationship, it takes time to grow, and it's patience. Now, one thing I can tell you, it's patience.
Now, when you're preaching to the choir in that sense with us, I mean, I think we've coined that real estate is definitely a marathon. It's not a sprint. To create wealth in real estate, it's long term. You can't day trade it. It's not like a stock, right? You're not going to be looking at what's happening with my values today compared to yesterday. That's not how real estate really works. And I think the guys and gals that are watching, we've drummed that enough in their heads, especially if you watched previous brunches and content that we've done. Now, Chris, I do want to speak about how to pull out equity out of your home, because a lot of people that are watching, majority of people in that's an REC insider, they own their principal residence and they have equity in their home. It's just sitting there. I want to walk everyone through that process. I think it's going to be very valuable, as Tyler's mentioning in the comments. If you have questions, guys, make sure to go to the Q&A section. Drop your question in there. We will get to your questions in the next, call it 15, 20 minutes. So, Chris, let's walk people through how to pull equity out of your home. And why would you?
Absolutely. So, first home, how much equity is in the home? Everyone asks, how much can we buy for? Well, it's how much can you afford is the question that I have. And pulling out equity, it can be in the form of a line of credit, or it can be in the form of a refinance. As you mentioned earlier, rates are definitely cheaper than they were in the last 15 years. And the spread between fixed and variable, like we mentioned earlier. But pulling equity out it's a strategy. How much do we pull out? Are we pulling it out from the home line, or are we pulling it out in the form of a refinance? And the difference between the two, for all of our viewers, is home equity lines of credits are calculated very differently compared to a refinance. Home equity lines are calculated based on the Bank of Canada's benchmark rate at 4.79%, amortized over 25 years. What does that mean? That means it's their cost of borrowing and your total debt service ratio increases. Whereas if you were to refinance your property to get into a second unit, that's okay. We'll refinance the property. Money's cheap enough where even if you refi today, your payment would be in and around what it is today anyways, with the money out, where we can now go and purchase that $500,000, $600,000 property. Okay, so
are you referring to the interest rates being so much lower than when you bought the house that after pulling out the money, the interest rate difference alone is going to keep the payment the same?
As of today, for today, yes, because rates are so low.
That's insane.
So why not pull out the money, right? We've always taught all of our investors for all of these years to borrow against lines of credits. And that's just the general rule of thumb for most anyways, right? But take your money leverage your principal residence, take it from your home to go purchase another property. Call me, we'll figure out how much you can qualify for. But with now, it's like a stress test, right? Where anyone that purchases a property has to get qualified on the stress test. And it's similar to lines of credits.
I get this question all the time, Chris. Is there an advantage to a line of credit over a refi for the sole reason that in a refi, you have a fixed cost? So like the minute that, let's call it 200K comes out, or this 100,000, let's use an easy number, 100,000. So is it better to get 100,000 out as a second mortgage or as a refinance of a first mortgage? Or is it better to take it as a line of credit where you're only going to pay the interest when you use it? That's a very, very common question. Is there, I know everything is case specific, but like from a general outline or a high level, what would you say, like for somebody who doesn't know what they want to buy, but they want to be ready? Should they pull out the money via refi, or should they set up a HELOC, a home equity line of credit, if they want to buy in the next 6 months? What should they do today?
Amazing question. Based on their financial situation. So when I designed that financial blueprint and I design it for them, I'll tell them at that time, it's time to refinance your property, pull the money out because you can qualify to go purchase that rental property, or use the line of credit and use it towards the down payment in the event that you can qualify at the higher interest rate.
The defendant hasn't answered my question.
No, but
I'm joking. So let me just, to get to the bottom of it, would you say 100% it's case specific? Because it's that easy.
100%.
Okay, cool. So if you need to, like, as a general outline, there is no such thing. Don't generalize such a decision. It's case specific. Speak to Chris, speak to someone knowledgeable to get proper counsel. That's the advice?
Absolutely. Remember, it's easier from an accounting perspective for people to go get a line of credit. The problem is when you go to get a line of credit, the banks are throwing money at you and saying, oh, Mr. Customer, as Jas mentioned earlier, you've paid down your home for the last 5 years. You've got, 40% in equity in your home. We're going to give you 80% of the value of your home, and we're giving you a line of credit of $350,000. Well, guess what? I can't do anything for you at that point, because that stress test that I'm talking to you about, that 4.79 at 25 years, it increases that payment substantially to the point where I can't do anything.
It doesn't make sense anymore.
So I have to redesign it and show you how to refinance your property, keep your payments low. We'll purchase another investment property. Once we get into that property, then we can start using that as your piggy bank to pay yourself back.
Now, let's go ahead. Okay, I was going to say that let's walk somebody down an example right now. We're having brunch. Everyone's chilling back. We got people on their honeymoons. I want to make sure that we walk people through an example.
Okay, so Jazzy. So before you go into an example, I wanted to make a point that is before that. So before we close off the credit conversation that we were just having of a refi versus a line of credit, I also want everyone to remember that although mortgages are on the good debt category, a line of credit still has an R in front of it on your credit report instead of an I. The difference is an institutional loan which is a mortgage, which is actually an M, but an M or an I is an institutional loan, which means fixed. A revolving line of credit does make an impact in that credit score, in that debt carry. So for everyone to understand, although the HELOC is secured against your home, it's still a revolving line, and the maximum value of that HELOC is going to be used against you when you're looking to refinance.
Well,
Correct?
the bank is also, Chris, is that correct?
Yeah, so it depends on the lender. Some lenders will allow us to use the limit. Others will use the balance of the line of credit.
Would they make you then close that off?
No, you're not closing it off, but you're just qualifying it based. If you have a $350,000 line of credit and I only need $100,000 to get you into a $500,000 unit, well, I only need $500K. But if I have that extra 250 to play with, then it's negatively going to affect your borrowing power.
Got it. Thank you. I just wanted to get that point in. Jazzy, take us through that example, brother.
Well, first, Q&A's lighting up. Guys, keep going into the Q&A. We are going to get there. We're going to put Chris on the hot seat, as we always like to do with our guests. A, B, Chris, is how nice is it to see all the comments coming in with so many people that have done business with you in the past? I see all the comments at the bottom as well. So let's walk somebody through this process right now. Okay, we have $1 million home and I have a $500,000 mortgage on my, so I own my own principal residence. My principal residence is, the value is $1 million. I have a $500,000 mortgage on this property. How much can I pull out based on qualifications? Let's just walk somebody through a high level example of this. $1 million, the value of my home is $1 million. I have $500,000 left on my mortgage. What is the process to get this money out? Because people hear it like, pull out the equity. I don't know if everyone knows how it actually works and really how easy it is and how beneficial it is, because myself and Simos, that's what we do to increase the properties in our portfolio. We're always looking for other people's money. We've heard the acronym OPM. That's what it stands for, other people's money. And that's how you get access to cash. So Chris, walk our guests through this process. $1 million valuation on my home, $500,000 mortgage.
$1 million home, you can borrow up to 80%. Good example. 800,000 minus the balance of your mortgage, which is at 5. Now we have access to 300,000. But again, I don't want the investor to take the full $300,000.
Okay.
Not right away.
Okay.
That's where I designed it and say, okay, we're going to buy a property for 500,000. We're going to take $100K from the 300 that you have access to, and we're going to go purchase that $500,000 unit. Once we purchase that $500,000 unit, sure, now you can dip back into that extra $100,000 because you know you have the room. There's still $200,000 available. But I don't want all of it up front. And most people will come back and say to me, well, Chris, it's going to cost me more in legals, or, I have to get my property, appraised again. And yes, you do. In every business, there's a cost of doing business.
No doubt.
Chris, what is the cost, just off the top of your head? And I don't want you to lose your train of thought, but what's the cost of this appraisal and legals?
$350 and $800 on the refi.
Okay, guys. So we're talking about $1,200 cost to do business, to have access to, in that example, $100,000. Continue.
Okay, so now you take the $100,000, you buy the one unit. Once you purchase that other unit, now again, if I have to get an extra $100,000 from your principal residence, sure. If you're looking to buy 3, 4, 5 properties, I have to map it all out for you. When I map it out, it's a matter of saying, well, how long is it going to take you to get there? And in the event that we're leveraging your principal residence, what do we do to come back full circle to pay yourself back? And the answer to it is, well, now you've acquired all of these additional properties, and these properties now have built equity. Okay, so if there's built equity and you're buying one of your pre-construction units and you've bought it in 2018 and it's closing into 2021, well, you've got an appreciation in that property. So if I'm leveraging,
generally in the GTA, we generally see close to about $120,000 increase from agreement price to delivery date price. So continue.
Exactly. So in that event, we know we can forecast to say, well, if you're telling me that this is what the numbers look like based on the city that you're buying in, well, let's use that to our advantage in the sense of saying, well, we'll pay you back the money that you've taken from your principal residence. We never want to have you have a high mortgage payment just because you're trying to build wealth in real estate and build that portfolio. Right? Doesn't really make sense. But in the end of it all, if you know that it's a buy and hold strategy and you know that you're going to hold on to it and you can at some point later on down the road dip into those rental properties, well, now you can pay yourself back later on down the road. But
so some of these comments are killing me inside, and like we have a really savvy audience, Chris. Like a really savvy audience. Like a lot of these people have been doing this for a long time. And I saw first, Ken, we were talking about the costs. You can write them all off. Yes. Chris, then you said, don't take it all out. Take out $100K. And somebody just said, why not take it all out and investment in things that get you more money? Because it's not that easy to do safely. April. So April made that comment. It's when what Chris is referring to is a strategic blueprint. To expand on that, the reason there's a blueprint is because not everybody wants one property. Typically, we want to build a portfolio, call it 1, 2, 3, 5 properties. If you take and prematurely take all that money out and now you're done at that $800,000, you can't touch money again, you're limited to the mortgage you can close on. Meaning, so Chris said, take out $100K, buy that $500K property, wait. Why are you doing that? Because now on your next application, you're going to have the income from the income property, the equity of the income property, the equity that has grown in your home, and overall, you're stronger overall. Doing the second property will be a breeze. But
it'll be definitely easier to do. Yes.
Of course.
Yeah.
But well, there's a plan. It's not easier. There's a strategic plan. Chris, yourself, Jas, myself will tell you what to do. So it's not easier. It's 100%. It's if we do this, this will be the outcome. If we take out too much and now you have an $800,000 mortgage, you're going to buy one property. Now you're tapped. Even though, yes, you're sitting on 300, but you can't put it into another property to 5x the leverage because you won't qualify for the mortgage.
Exactly.
So April, and this isn't singling out April, it's answering your question from a high level. There's a huge reason why you don't take all the money out at once. And of course, that doesn't apply to everyone. I could take all the money out, you couldn't. Or you could take all the money out and I can't. So it will depend on your circumstances, but most of all, it will depend on that portfolio assessment that you're going to sit down with and do with us. It's going to be on that financial blueprint that you're going to sit down and do with Chris. So so for all those questions that are not specific, but more of a commentary, like just take it all out and put it into something that gives you more. It's not that easy if you want to build out a 5 or 10 unit portfolio.
Now, this process can take a while once you get started with Chris. And so I see a lot of comments come in. If you want to do your financial blueprint and get yourself prepared to be proactive before the year starts, I want you to send an email right now to info@reccanada.com, and we're making it very easy. And Chris has been kind enough to open up his schedule in the next coming weeks. So it's send an email, info@reccanada.com, and just in the subject line, all you have to do is put meet with Chris dash your phone number. In the subject line, it's meet with Chris dash your cell phone number, the direct line, and Chris and our team, Tyler, Ty Walbourne, our air traffic controller, will make sure we coordinate this financial blueprint one-on-one with Chris and his team. I cannot stress enough, guys, the importance of doing this before year end, because you'll come out of the gates ready for 2021. And I've seen it for 15 years. The last week of the year, there's always a couple of deals to be had because everyone else is nice and cozy in with their fireplace and their eggnog and rum. But most compelling deals are done where everyone else is at home. So it's info@reccanada.com. Subject line, meet with Chris, dash your phone number. We're going to jump into the Q&A very, very, very soon. So Bobby, if you can come on and be ready. But before we do that, I did want to touch on the part, Chris, as Simos mentioned, we have a lot of savvy investors because they've done this so many times now. And so they have more than 5 doors. They have 5 doors and above. And we know that the financing gets a little tougher. So when sitting down with someone, Chris, that has 5 doors or more, what's your process?
The process is very similar, but now there's you're in a whole nother bracket, right, Jazzy? If they're savvy, they understand it, then there's a tax component to it. You know that you got to file taxes on your corporation individually for all of your properties. And if you're going past 5 doors, are you in the position, we're talking about costs and we're talking about expenses and we're talking about that $700 or $1,200 overall that we were just talking about earlier. Well, when you're at the 5 doors, are you prepared to take the risk on knowing that the interest rate will be 1 to 1.5% higher, okay? And the bank will charge you a 1% fee. And sometimes, depending on the bank, they'll only loan up to 75%, meaning that you have to top up a little bit more money. Most, other banks will go up to 80% loan to value. Okay, that's how much money you're putting into the property. But my point is that everyone talks about rate. No one looks at the bigger picture to say, well, here's my deductions. Here's how much I can write off. Here's the bigger picture to it all. And we all want to make money in real estate, but no one wants to pay.
Yeah, look, I think cash flow, we talk about it a lot. Cash flow is very, very important, but that's only one way you win in real estate. We know that the values go up. You have your passive appreciation. You have your principal pay down. You have the ability to actually add value to the property. But the big one that I think that most investors miss is actual tax advantages and tax strategies, because that all 5 things, and there's a couple of other ways that you win in real estate as well, but that's the whole meal. That's how you create real wealth in real estate, by looking at the whole meal, not just the appetizer or the dessert. And to me, the dessert is the cash flow, because at the end of the day, if I have $1,000 a month positive cash flow, I'm really not making $1,000, because there's these people called the CRA that's going to tax me on that $1,000. So you want to look at it from the 30,000 foot view. That's something that Chris is going to be doing with our insiders in the next coming weeks. Again, his financial blueprint to get part of that and to book a time. All you got to do is send an email. Simos, did you have a point? I know, I could see, I've known you for a very long time. I can tell when you just want to come through the phone with something, brother.
I have so many, bro. Like, I'm just so effing sick of nonsense. So if you want to buy a property, bro, anyone out there, you want to buy a property, go buy a property. If you want to call yourself an investor, you need to do more than buy a property. You need to do more than call Chris and get a line of credit.
Exactly.
You need to sit down and fucking strap up. Look at yourself as a business person. Look at yourself as this is a real venture with real consequences. If I had $1 for every fucking Yahoo, and I hate swearing, but it really pisses me off. Like with the flips. Flipping is the most incredible way to make money. I love it. I personally love it. But when people come up and they're like, oh, I found a house for 800. You put 100K into it. I'm going to sell it for $1 million. Let's buy it. There's 100K. I'm going to make that 100K in 6 months. You just lost 50 grand. You dummy. You just lost 50 grand. Did you put your double land transfer tax in? Did you put your closing costs? Did you put your commission that you're going to pay your broker to sell it? Did you put in a contingency? Did you put in your HST? Did you put in a myriad of things?
70% of those questions, the answer is no, Simos. I mean, we have that experience, right? Like they just did not
what
work the
I'm saying
numbers.
is, I want everybody, and I don't care if you've done this 15 times or if you've never done it yet. Look at your structure. If you're a savvy, if you're a veteran, if you're a seasoned investor that already has done it, do you know how many times I get a consult on my portfolio now, right now? Every time I meet a new accountant, I still haven't switched accountants, but every time I meet a new accountant and they pitch me on, hey, is there anything I can do to get your business? Yeah, take a look at my fucking portfolio.
Tell me where I can save some money. Where can I save some money?
Come forward with value. Tell me what I'm doing wrong. I mean, a mortgage broker. Can I have your business? Sure, you can. Go ahead and earn it. Tell me what you can do better. But I don't stop looking for the next way to get a dollar back than what I'm paying, whether it's a net loss through a tax write-off advantage, whether it's a net dollar that comes into my pocket. People need to really look at their structure. Stop thinking you know it all, because you don't. Nobody does. This is why the brunch is here, is for us to have these discussions with people who we think are smarter than us. I think Chris knows more than me about finance, period.
And not only does he, and Simos, not only does he know more, didn't mean to cut you off there, brother, but he has the network, he has the connections. You and I have been in this for a very, very, very long time. We don't know the actual underwriters in most cases. Guess who's one of the most important people in this process? Is the underwriters. And so, look, we talk a lot about
which change all the time.
All the time. That's Chris's job. That's Chris's job, to make sure that he's staying and whining and dining all these underwriters. I know what has to be done in that sense. Right. And so, look, you have to. I like to think that we are very important in the process as the real estate advisors. We're going to have one of our 39 agents out and about with you shopping. But truly, the most important person in the process is the mortgage broker, because they're the money men and money women that you need to be connected with, because they're going to make sure. And I love what you do, Chris, and you've been doing this for myself personally, my family, and a lot of our clients. Is you're not trying to only look for the one property. You know, I think maybe we mentioned this earlier, but I say it so many times, it's a blur to me that you're not only looking at my portfolio for my next property. It's like, Jas, how am I going to set you up for number 7 and number 14 and number 18? And that takes time, guys. That's why you need to do that one-on-one. Our Q&A is lit up. That's why you see the beautiful, beautiful face of Mr. Bobby Puim, loving the Christmas tree. Your head's in the way a little bit, but I love that you're in the festive mood, my man. How you doing, Bobby?
I'm doing well. Yeah. I mean, my desk got pushed out of the way for the Christmas tree, so it's a little tight quarters in here nowadays, but Merry Christmas to everyone, I suppose, right?
Awesome. Merry Christmas to everybody. We will talk a little bit after the Q&A about what's happening in our last brunch of 2020. Make sure you stay for that. We got a big announcement for our last brunch of 2020. But Bobby, take over, my man. Let's rapid fire questions at myself, Simos, and Chris. I'm sure it's majority for Chris because he's done a fantastic job walking our clients through the process. So go, my man.
That's true. So, Chris, the first one is, I hope that you don't like the luxury of sleep. Somebody said that earlier in the class. You're going to be a busy man leading into Christmas.
As you can see, I don't know if it comes to this camera or not, but yes, I was worried about the bags.
All right.
I'll be honest 1 second, Chris, bro. Like, honest to God, your face hasn't changed since I've met you. So I don't know if you're going to start like you're a robot. Like, bro, you don't age. You're a handsome motherfucker.
Thank you, Betty. Thank you.
All right, Chris, my man. From Nancy, I'm being told for residential rental properties that I cannot obtain a business mortgage, and then I have to be a personal guarantor every time. How can I get past this to move the mortgages over to a business or commercial mortgage?
Moving it over will be tough. There will be a land transfer tax component to it. We would let's work out those costs and see if it makes sense. If they're in a situation where you have no choice but to move it over, and you know, I've had a a few bigger, investors that said, we don't care. We're going to pay the money. You know what? We just don't want it under our name, and they've done it. But there is a land transfer tax cost associated to it, which everyone does need to keep in mind for that individual there.
Awesome.
And I will say, just from a commercial perspective, because I'm in that world every day, I have seen a massive increase in the last, I would say, even 5 years, Chris, where the banks are demanding personal guarantees on what before they would underwrite for straight corps. They're putting the directors or the major shareholders on the mortgages. They really are.
They are, yeah. And a lot of the banks don't even have the appetite for corps, right? Yeah. Which is the other piece to that, building your team of experts. Once you have the right team of experts in place, including that accountant that we were talking about, we need them. We need their help. In order for us to do our job, we need to ensure that everyone has the right people in place in order to ensure that they're getting educated along the way from all assets of the process.
And so that's why it's so important when you build out your real estate all-star team. Look, you don't have to use Chris. You don't have to use us. You don't have to use anybody on our preferred suppliers list. However, it makes it easier as we quarterback the process of getting you into an investment property. Because look, I mean, if Chris, for some reason, wasn't able to get back to somebody because we've been together for 15 years, we've essentially been married for 15 years. I mean, it's easy for one of us to pick up the phone and say, Chris, what's going on? You haven't called back Julie yet. Like, what's happening, brother? Like, it's easier when everyone is part of the same circle / family. And so we urge you to use our preferred list. We're not perfect. So if you know of somebody that should be on our preferred list, just always send us an email. We're growing. We want to help more people. And so again, I can't stress enough the importance of making sure you build out your real estate all-star team.
From our boy Ken, what are the rules regarding down payments? Some say the money must be in your bank account for 3 to 4 months. Others say that's not true. And he's got 2 parts to this. And do you only broker properties in Ontario, Chris?
So the money in your, depending on where the money is, how long it's sitting in the account, it depends on the lender. Some lenders want to see 90 days. Some lenders are okay with 30. But again, it all depends on how we map that out and where we go and what institutions we're going to. And are you using that line of credit? And are we going to an alternative lender because you don't qualify with an A lender today? But in 2 years, or in that year after we've got you into the property and it's appreciated in value, we'll come back full circle. We'll get you back on an A lender. But it's getting in, right? It's more so getting into the property. So hopefully they can take something away from that piece there.
And the second part, Ontario, outside Ontario, what's your firm set up?
Yeah, we have access to outside of Ontario. Our office is extremely aggressive out west as well. Okay. Please, and we have partners out there too. So by all means, if there's anyone that's looking to, I do get a lot of calls from Calgary and Edmonton, and then getting people from Saskatchewan, and they're looking to invest in Toronto.
Nice.
So that's good.
Okay, Bobby, go.
Just before we go to another finance question, there was a couple of people asking about, is it better to buy townhouses, etc. Remind me, because I don't want to kill the momentum for Chris and the finance questions. Before we end it, I do have 3 or 4 little opportunities that emerged very timely. I can share those either with the entire audience towards the end, or I can shoot an email to whoever's interested after. But just don't let me forget, because there are a couple really little things that are opportune. Go ahead, Chris or Bobby.
Awesome. From Norda, I have 2 more years left on my mortgage term at 3.19%. If I refinance, there's a $10,000 penalty. Isn't the HELOC better? This is back when you guys were talking HELOC versus mortgage.
There's a 2-part to that question, though, right? One is 3.19 is a substantially higher rate than what we can get you today. So going back to earlier in the call, if you were to refinance your property and you were to pull the money out based on the lower rates that we have today, your payment will be in and around what you're paying today at 3.19 anyway. So we got to work that piece out. And yes, if we do decide to do it, if you have enough equity and we can do it in the form of a line of credit, then let's use it. We can do it. But just be aware. I want everyone to be aware that lines of credits can be used not with all institutions. Okay, they're moving away from corps. They're moving away from lines of credits. Everything that's going on with COVID, we're in different times. So
COVID, man.
We got to change with the times as well, and whatever the new norm is going to look like, well, we got to adjust to it as well. And if that's the case, and you got to borrow the line and you got to go to an alternative lender, but you can see the value in that appreciation in that property in the next 3 to 5 years, then that's the step we take. If you don't have the risk for it or you don't have the skin, then we don't. We pause, we wait. You sit where you are until you're ready to, there's no rush on our end, right? Whether you buy
Jazzy, throw the goaltender that's scared of the pucks equation in there.
Look, if you're scared of real estate values going up and down, it's very similar to being a goalie in hockey. Probably shouldn't be investing.
Can't be scared of the puck, bro. Can't be scared of the puck.
Well, if you're a goalie, how can you be scared of the puck? You're fully equipped.
Well, hence why you can't be an investor if you're scared of values going up and down.
Yeah, exactly. Absolutely.
Yo, what's the Smith maneuver? Bring that guy on. I want to know what the Smith maneuver is.
From Diana, if we got a HELOC 3 years ago based on our house being worth $800,000 and now our house is worth $900,000, can we go back to the bank and, in quotations, refinance to get that new $100,000?
Yeah, for sure. As long as the value has gone up by enough in order to give you enough money out for it to make sense after all of the costs, right?
Yeah, so it went up 100,000. She could possibly get an extra 80,000 now, possibly, depending on her situation, right, Chris? Yeah,
depending on the situation. I think it sounds like she's already close to the 80%. So if it's only gone up 100 grand, there's not much room. I can tell you that off the bat.
All right. From May. How do you go about financing commercial vacant land for future development?
That's a whole nother beast.
That's commercial. So that's not even a regular commercial deal. That's land banking commercial financing. That's a whole other beast.
Like that's another 5 brunches. That's probably another 5 hours.
That one.
But send us an email. I was going to say, May, send us an email directly to info@reccanada.com. We have people that we can put you into connection with and make sure that we can walk you through the process and make the right connection. So send us an email at info@reccanada.com, May. We will definitely be able to answer that. But for the sake of time here, that's a 3-hour, 5-hour course on its own.
Oh, yes.
From John, the bank wants to use 50% of rental income as opposed to 100% of employment income. Is this standard across all lending?
Say that again, 50% rental versus 100% employment?
Yes. So if I earn $100,000 a year, the bank's willing to take into account that I make $100,000 a year when financing me. But if I make $1,000 a month on my income property, they're only willing to say that it actually accounts for $500 a month.
Got it. Depending on the bank. Some banks will go up to 50% and use a 50% rental offset. Others will go up to 80.
That's right. But that's quite common. 50% is quite common.
Yeah, 50% is usually the norm.
For the big five, yeah, it's pretty common, I would say.
Yeah. So there is. You go 50% for the big five. Even outside of the big five, to be honest with you, there's a lot of appetites for 80%.
And that's why we leave the big five in most cases.
Absolutely.
So
I got mortgages on my property, guys. I don't even know the lender's name on them. Like, I want to make sure people understand this. Like, you don't want to hear from your mortgage company. The chances if they call you or email you or text you, you probably missed a payment. Like, this thought process that we need to work with the 5-6 major banks, please. I know a lot of people are savvy on this brunch, but there's also newer people. Get rid of that. Get rid of that.
Yeah, being lender specific is not going to help you grow your portfolio in real estate. Not at all. We'll map it out for you. We'll show you where you need to be and how you need to get there. I'm your GPS. You plug in your address. You tell me where you want to go. I'll tell you how to get.
I love that. I love that.
It's better than my quarterback analogy. Chris, are you outdoing me on my own brunch, bro?
A little thing here and there, Jazzy.
An old friend of ours used to say, marry your mortgage broker, date your bank. And I always really took that to heart.
100%.
Is it normal, from Susan, is it normal for practice for a mortgage broker to charge a 1% or $5,000 fee to place a mortgage when purchasing in a corporate name?
For sure.
Yeah.
Maybe more.
Well, you're buying it under a corporation. There's a different, I don't want to step on any toes here, but when you're charging fees, it's the bank that's charging the fee. And we as brokers, we don't get paid by alternative lenders the same way we do by, the top 5 banks. So yes, we've got to make up the difference in the spread. We try to get to 1%. There's no secret. It is what we're helping. We're trying to get you to where you want to be. And yes, if the bank is charging 1%, we typically will charge 1% as well.
But I've seen much higher fees, like depending on the deal, guys. So like if this is a high risk deal with in engaging private lenders, et cetera, in commercial real estate, I've seen 2%, I've seen 3%, I've seen all sorts of different fee structures, and it's 100% related to the difficulty of the transaction and how much profit is in the transaction. Mm-hmm. Everybody's going to eat. So you're not the only genius. You're not the only game in town.
Yeah.
So yeah, it just really depends.
From Randa, I have several properties with over $300,000 in equity in a couple of them, all in my name. I can't qualify to get the equity out. Everyone is talking BRRRR, but I can't refinance. How can you help?
Email info@reccanada.com.
That one sounds like I'm going to need a little bit more time, outside of this call.
I would love to gauge that. So if we are able to help Chris, I would ask you to keep Bobby involved in that one. And maybe, just maybe, it can make it on a brunch success story.
Sure.
info@reccanada.com. Very easy, guys. Just in the subject line. Jazzy still writes majority of his emails in the subject line. So I want to bring you into my world for a second. All you have to do in the subject line, write meeting with Chris and your cell number, and anybody, I should say, that's requests it will get taken care of in the next couple of weeks. Chris, thank you so much again for opening up your schedule. We got tons more questions. Bobby, do your thing, brother.
What's the major differences, like risks and qualifiers, between what an A lender and a B lender require today with COVID as well?
Oh, good question. Whoever that was from.
Good question.
A. Yeah.
Yeah. So with COVID, banks are now asking for more. Okay. And they want to make sure, yes, you're employed. You haven't been affected by COVID. And if you do have multiple properties, has your tenants been affected by COVID? And if I'm going to qualify you to pull equity out of that home, are you getting the rents? And if you are, yes, the lease says $2,250. Show me the deposits going into your account.
Yes,
we see it now. We need to show it. And I agree, to be honest with you, because it's not just in good faith. It's to ensure that if I'm helping you grow your portfolio, we also need to make sure that you're going to qualify along the way. And that's going to determine the banks that we go to, whether it be that alternative lender or whether it be the A lender.
So this is a good learning moment from everyone. What Chris is referring to and what you might be asked for are called rent or lease estoppels, which serves kind of like compare that to an affidavit. So it's a paper that's going to be signed by you and or your lawyer certifying, and your tenant, excuse me. So it's going to be saying that Unit 101 pays $1,800 a month. Tenant signature, landlord signature, notary. Jas is in 202, pays $2,200 a month. Bobby pays $3,000 a month. And these estoppels serve as proof, along with bank statements showing the deposits that go to your refi, that go to if it's a sale or what have you. So those are typically called estoppels. And they're very common in commercial real estate, but we are seeing them come into that 3 to 8 portfolio properties as a result of COVID and as a result of risk mitigation.
That's it.
We have a lot of very specific questions that I feel like are going to take us hours to answer, unless we then just push everybody back to Chris at some point. So Jas, tell everybody how to get back a hold of Chris, please, again.
info@reccanada.com. I just saw honeymoon. I can't believe somebody's during their honeymoon, they're watching Brunch with REC.
He's going wine tasting.
I'm getting
All the best to you guys.
I'm getting goosebumps. I love you guys so much. This is amazing. Info
Go
at
enjoy your wine. Go enjoy your bride.
100%. info@reccanada.com. Subject line, meeting with Chris with your phone number. As Bobby mentioned, and obviously as Chris knows, when it comes to financing options, lender options, your personal situation, these calls are going to take a while. And so I know how patient Chris is. And if you think I like the sound of my own voice, you're going to meet somebody who likes the sound of his own voice a lot more than myself. Chris is very, very, actually one of the most patient people I know. He's going to be able to walk you through this, but this takes time, guys. And so it's hard to answer a lot of the personal questions because we don't know how long have you been working at your current job? Are you self-employed? Are you salaried? How do you get paid? Like there's so much involved. So the best thing to do is get into Chris's calendar by sending that email to info@reccanada.com. Bobby, is there one or two that you think you might be able to pick out that might be like direct answers that Chris can give to kind of everyone here?
Yeah, I think I've got one from Nancy here.
Okay.
Our rental properties have increased in value. We are in fixed mortgages for 4 years and are a year in. How can I get some of the equity out?
Can you repeat that, Bobby, just so I can follow Chris's answer?
Yeah, so our rental properties have increased in value. Nancy says we are in fixed mortgages for 4 years and are a year in. How can we get some of the equity out?
Oh, this is very common, Chris.
Yeah. So we can that's where you can now get a home equity line of credit. We can also calculate the rate differential between what they have a year ago versus what their rates are today. Let's figure out and decide, does it make sense from a numbers perspective to break the mortgage? And if it does, can we, does it make sense? Like, are you going to be in a better position after 8 months? And more than likely you will be, but at least now you have the money to play with, and you can go purchase that next property or two. And the bigger picture around it is, even if it does cost you, fine, maybe fixed wasn't the best route to go, knowing that you may want to, additionally and continue to grow your portfolio, but it's okay. We'll build off of it, and we'll make sure that you now can purchase another one with the equity on the form of a line. Or I'll do the calculation to figure out how much it's going to cost you, after what your break-even point is to make.
I love that you said, does it make sense, right? Because I hope not everybody watches this and listens today. And if you're watching the replay, thank you, that you have to do this and you have to do it right now. Like you actually have to buy right now. What we are hoping for is that you sit down with Chris to see if it makes sense, because you might need to wait, especially in that situation. You work out the penalties and it's like, this is not going to make sense for you, whoever asked the question. Let's just be patient. Let's wait. Let's be grateful for the fact that you already have some properties. You've already seen equity growth. Like, that's awesome. And so we might just need to, and that's why I think it's so crucial that you sit down with someone like Chris in the near future, because it might just be, okay, guys, let's wait 6 months. Let's wait a year. We might not be able to pull out equity right now. We might not be able to get you financing, whatever the situation may be. But I hope everyone understands that this is not about that you need to do this now and you need to do it 15 times over. It's a matter of building out a blueprint and then reverse engineering that process.
So for that person, if it's a matter of waiting 2 years, to your point, Jas, let's wait the 2 years, but we can map it out today. Properly, in order for you to determine what you're going to do in those 2 years and those 2 years moving forward.
And maybe next time we won't go fixed and we'll go variable. Sorry, Simos.
You got it.
Like, for me, it just reiterates, and this is like, I hate saying it 15 times in every brunch. Like, what Chris said is like, if you had a fixed mortgage for 4 years when you knew you were going to be growing your portfolio, it's okay. We'll build from there. That's what he said, because it's so nice. You're so nice. I'm not so nice. This is the lesson. So whoever wrote that question, I'm speaking to you. You have to spend more time building your all-star team, because the only limitation that you're putting on yourself is you. Meaning that you got a property, you did a leap of faith, you've done a lot of things. Your property is growing. Could it have been done better? The answer is yes, only because if you work with somebody who would have said, don't do fixed, because I know, Mr. Investor, that next year you want to do this again. So stop. We're going to pay a little bit more now or a little bit less now, or whatever the case may be, but we leave ourselves open. So what we're referring to again and again is strategy. The difference between most investors, they can both be teachers, they can both make $100,000 a year, they can both live in the same neighborhood, but one of them has 6 properties, the other one has 2.
Yes.
And it's because not one of them was a bigger spender or a better saver. It's because they deployed a better strategy. They deployed a different team, a team that is more focused on growth as opposed to transactional or short-term objectives. They look for the long game. And this team that you're looking at on your screen right now is made of, including myself, because I will never give myself less credit or more credit. I will say that I ask every day. I keep growing every day because I seek help every day. I ask Bobby for his opinion. I ask Jas for his opinion. I ask Chris for his opinion, not because I'm an idiot and I second guess myself. It's like, have you heard anything better lately?
Mm-hmm.
We all go to the same sources, but everybody knows somebody who somebody else doesn't.
Yep.
And that little nugget is going to make $100,000 difference over the next 10 years. So that's the lesson. Nobody's being spoken to, or I'm telling you what you're doing wrong, or this, that, or whatever. It's just make sure that always, and don't paralysis by analysis either. That's not where I'm going at all. I'm saying shoot, keep moving, but deploy your best assets. And that's the people that you know are the best at their job.
Awesome. Guys, if you can just put it out there that, for anyone that is looking to call and does want me to review their portfolio, I also need to make sure that they've set aside at least an hour to an hour and a half for that call. Whatever the info that you send over to me, let's schedule it. I'll reach out and let's build from it.
Guys, we do these with Chris personally, like for our personal portfolios, and almost every single time I come out of it with access to more cash. Do I deploy it all the time? No, I'm a very conservative guy. You guys know my story, you know Simos' story, our backgrounds. We don't take risk. Like a lot of big risk. We're very conservative people, but we like to know that we have access to capital, because then we can deploy it if something comes, if a compelling opportunity does come. That's the objective of you sitting down with Chris. It's not to do deals. It's just to see if you can get access to capital, which will allow you to do more deals. That's why he is known as the money man. And so if that's what you want to call him from moving forward, I think you'll get into his good books. But he truly is. He's the one that's freed up a lot of cash for me personally to then have the ability to go invest. Bobby, why don't we take one or two more just for the sake of time? And for anybody who's been coming on late, we have been blessed with Chris De Souza, broker at Sherwood Mortgage Group. This man has been helping us invest into real estate and our investors for the last 15 years. Make sure you go back and watch the recording. All you got to do is go to REC Canada's YouTube page. Just search REC Canada in YouTube. You'll see all the past recordings as well. So, Bobby, go throw one or two more questions. And thank you again, Chris. Really appreciate your time here, brother.
No, thank you. Thank you for having me.
I also think we should change Chris's name on the Zoom screen to Money Man. So Money Man. Perfect. I like that one. From Vikram here, how long does the current refinance process take, Chris?
It doesn't take long. If you have all of your ducks in a row and you have all of the information that I need, I'll walk you through a 3-step process. So as long as you can follow my lead within that high level from within those 3 steps, then anywhere between 15 to 20 days. It doesn't take long.
It's what? It's initial consult, application, appraisal, underwriting, approval.
Yeah, and it's the other moving parts, the appraisal, getting the instructions sent over to the lawyer, having the lawyer pull title, search, do all their searches. It takes time. Getting the money from the funder to get to the lawyer to close on the property and register it. Those are all the different moving parts that'll help speed up the process. But depending on how quickly they want it, we can adapt to it as well too.
Yeah, guys, completely anecdotally here, I suppose, but I just went through a refinance. We just pulled another $80,000 out of one of the properties that we own, Laura and I. Mm-hmm. And from beginning to end, working with the broker that we chose to work with. I'm sorry, Chris, not you.
Okay, next time.
Damn right. That's a salesman right there.
but from beginning to end, I believe
you we were always work with the best, Bobby.
Yeah.
I owed a favor. No, I'm just kidding, right? I love who I used as well, right? But from beginning to end, about 30 days. And we were pretty quick with it, right? So budget about 30 days. I know that Chris can turn them around like that too. So,
how long does it take the average person to make $80,000? And you did it in 30 days.
There it is.
Net.
Oh, net.
No tax on it. No tax free. How nice is that? We need to make
turn that into another
160 Gs. Sorry, yeah. Bobby.
There it is. All right. I'm going to turn it into another unit with Laura, and that unit's going to cash flow and on and on and on down the line. It doesn't stop at the 80K.
That's right.
It's awesome. From Laura, can Chris comment on the latest news that HSBC is offering a record low interest rate of 0.99%?
Holy guys. Okay. So the rate.
Leave it to Hong Kong to do that, eh?
Yeah, guys, rates are published, and we don't do this, okay? Myself, my team, my office, we don't sell rate, okay? I'm selling you service. And everything that's put out there is to get the phones ringing. How do we get those phones ringing based on that low rate? Understand that any rate you see that's low is always advertised if you were putting less than 20% down. It's an insured product. The insurer pays the premium. You pay the insurer, and the insurer gives you a discount on the rate, which is why the rates are so low on an insured product. And you're limited to 25 years.
And sometimes it's an introductory rate as well. It's only offered for a certain amount of period of time. And guys, in the advertising world, that's called bait and switch. I just want you to be careful of it. Do as you please. It's like reading
the terms, Jas.
Sorry?
Look carefully.
Yes.
Ultra carefully at the rest of the terms, like portability, payout, penalties, interest. Like, come on, guys. Let's not fall for nonsense.
Yeah, well, and just like anything else, right? Be careful of just reading the headlines. Try to dive a little bit deeper into the actual meat of an article. And when it comes to rates like that, bring them across Chris. Send him an email and say, "Hey, Chris, what's up? Like, is this true? Chris can take you there as well. He can take you to majority of these lenders that are offering these rates, but at least he can dive through and declutter." I think is the better word, declutter through all the nonsense and at least bring you to the straight goods so you don't have to spend that much time doing it yourself.
Sure. Shouldn't it speak volumes that the 3 foremost experts that I know on this panel here today laughed audibly at that interest rate?
Yeah.
Like, actually just talk to your broker. If Chris says he can get you that rate, then great.
That's it.
If he says that the best you're going to do is 2.39, that's still free money in this country, you guys.
Yeah.
Understand that part.
Go ahead, Chris.
If I can add very quickly, having a higher interest rate is not a bad thing. Okay? It actually helps you later on down the road to acquire more real estate, Yes, it gives you a bigger tax deduction in your write-offs, and your accountant is the guy to talk to about all of that piece. But it does, in the end, help you out on the grand scheme of things, knowing I have properties that are at 4.99%, but it's too bad for me. I have no choice. I have to, it's what I have to do. But I know that property is going to appreciate in value. I know I'm holding it onto it for 25 years. It's my retirement. Yes, the rate is higher, but it's a forced savings. It's going to come back to me later on in the end.
Guys,
Well, it's also because your money. It's also because your money bags and you have 100 properties. Probably.
Yeah.
It's actually quite simple, right? It's simple math, guys. I don't have a university degree, but I don't need one to understand if somebody's giving me $1 at 4%, but on that dollar, I'm going to go make 25%. I'm laughing at the bank because I just made, I made my 21%. It's quite simple. How I get the dollar is where the work is involved. That's where the work is involved. That's why if you have not yet sent an email to info@reccanada.com, subject line meeting with Chris and your phone number, I need you to ask yourself why. There's no cost to it. You're going to sit down with Chris De Souza and his firm, and he's going to do a financial blueprint to get you prepared, possibly for the end of 2020, because it's not over, and we all know that the thoroughbreds come in at the end. However, to get you really prepared to come out of the gate strong for 2021, because REC has a lot planned in terms of new opportunities coming up. We're also seeing a lot of income properties on the market, but most people are not prepared because they haven't taken care of the money aspect first. So that's why it's so important to get in touch with Chris De Souza. We got one more question. Let's give him one more question because I know you were tight on time, and then Simos and I can kind of close off and let you know what's happening in the next couple of weeks. Go ahead, Bobby.
The best one I think that isn't too specific here relates to something that I said. Is the money still tax-free on the refinance if you don't reinvest it?
If it's not being used towards an investment, then no.
Then it's income.
They're refinancing, he's saying.
Yeah.
So it's tax-free.
If you refinance, here, I'll pose the question in a different way for everybody here. Ready? If I refinance that $80,000 out and I went off and I bought a boat, is the $80,000 still tax-free to me?
Yes.
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 Yes. Whatever you buy. It's
guys, you can go to Vegas. You can go to Vegas and put it on black or red if you want to.
There will be
you to do with it.
So somebody is asking you on a refinance, the funds are not tax-free, I think it's saying.
So the question was, is it still tax-free if you don't reinvest it?
Yeah.
Okay, if we're done with the question, I just have a couple of points that I want to make. The biggest one is I want to remind, like I live in the city of Mississauga and work in Toronto, so I'm going to speak just a tad bit more local, only because I know this market like I know my own hand. Every single person who has owned real estate for more than 12 months in the GTA has seen an annual appreciation of 20 to 30%, depending which market they're in. If you've owned it for 5 years, you're up probably close to anywhere between 60 and 100% of what you bought it for 5 years ago, 8 years ago, and so on. Let today's episode be a reminder. Let today's episode be the reason that causes you to move. Get up, figure out a time to speak, whether it's with Chris, whether it's with your own contact, whether it's with your bank. Take whatever advice you got today, do the best with it. Look at your options and make 2021 the year that your existence, that your primary residence fuels the legacy and wealth building over the next 1, 5, 10 years of your life. Make it today. So my announcement to everybody in the GTA, because if in Red Deer, or in Calgary or Vancouver is acting the same, we can always put you in touch with our equals there. But you're not going to use Simeon to buy in Calgary because Simeon doesn't know the intricacies of the Calgary market, etc. You're going to use a local professional, which is the segue into what my partner beside me has to mention about the next brunch. So for me, let the wealth and insight that Chris dropped for you inspire you and get that equity out of the house and make a move that's going to make you tens or hundreds of thousands of dollars.
If not millions. If not millions.
Hit them with
Over the long period of time. This is not a get-rich-quick scheme. You said it amazingly, Simos. It really is the foundation of what we've built here at REC Canada is to take things nice and slow and create long-term wealth. A lot of you have come to us and said, find us a flip, and that's kind of our business model from the investor's perspective. It's just not what we really focus in on. We really help people create long-term wealth. And I'll tell you why, it helps us sleep well at night, guys. I'll peel back the curtains here. Okay. As co-founders of REC Canada, it's quite easy for us to sleep well at night because we know what's going to happen with values. We're gonna show you something that's worth $500,000 today, and we know what's going to happen in 10 years on average. We're not geniuses. We're not Nostradamus. We know it's going to double on average. So we know it's quite easy for us to predict that. Two things. A, in terms of getting in touch with Chris, please send that email to info@REC Canada. You know what to do in the subject line. I've said it 69 times already. Subject line is meeting with Chris, your phone number. There is a couple of opportunities here and there that we've patched together. Send us an email to info@reccanada.com and just write opportunities. We'll send you that. Tyler's been putting that in the comments. info@reccanada.com, and you can put the subject line opportunities. We'll send you links by the end of the weekend, and you'll have that in your inbox. And then you can get on a phone call with myself to talk about if it could fit in your portfolio. Third thing actually is I want to make sure that you understand what we're going to be doing December 19th. It's our holiday special, so we're going to have some fun. Can we have some eggnog at 10:30 in the morning? I think we can.
And Rob.
Okay, so we're going to have some eggnog, but we're not going to be flying the plane. We'll have some other virtual pilots with us, but we're going to be taking a flight right across the country, guys. We are going to have 8 to 9 investor-savvy realtors from the major cities in our country to be doing a year in review. We're going to be doing a year in review with what has happened in the real estate market in those specific cities and their forecasts. We're going to have some of the top real estate advisors.
Ugly sweaters.
Ugly sweaters.
Ugly sweaters.
Let's do it. Let's do ugly sweaters. Now that you put it out there, I guess we're going to do it. Okay, so we're going to be taking a virtual flight right across the country. Make sure you check your emails, because we have been hearing that we've been going into some of your spam folders. So please make sure that that you get this email for December 19th. We'll be sending it out in the very, very near future in the next couple of days, because I'm so excited to have so many of our friends on, investor savvy realtors, to do this year in review with us. Chris De Souza, I see the name change happen, the money man. I love it. Mm-hmm. Just so you know, I think we're in the hundreds now, almost close to, with appointments booked for you. Get ready, buddy. Get your rest, because starting Monday, Tuesday, you're going to be going crazy with financial blueprints with our insiders. Chris, I love you. Thank you for everything you do for our clients, our friends, our family, and for all the energy and knowledge that you brought today.
No. I'm going to put everybody here on the spot. Chris, if you want to be put on the spot too, you have a choice of saying, no, I don't mind, but you probably don't want to.
Okay.
Are you ready for this? This just happened.
Go.
This is what I do to you every time. This is what you cry about at home.
Every single time.
Every single time. Are you ready?
Oh, man.
This is what I'm going to do. We still have more than a few hundred people watching right now. I talked about ugly sweaters. Okay? So for December 19th, the holiday special, I encourage every single one of you to put on an ugly sweater. I encourage every single one of you to email us a picture of your ugly sweater.
Or tag us on Instagram. That's what we'll do.
That's what we'll do. Okay. So
Yeah.
we'll line that up. But regardless, get ready for it. But whoever's got the ugliest sweater out of these mugs right here, you know what, Chris, you're not on there, so it's not going to be fair. I'm going to tell the other participants for next week. But between me and Jazzy, ugliest sweater, $500 each to a charity of the ugliest sweater of the entire webcast. So I put 500, you put 500. But if whoever wins from us covers the other guy. So it's going to be
let's up it. Whatever you said, we'll put $1,000 each into it because we're going to make sure that it goes to our favorite charity, which is Sick Kids.
No, not our favorite. Let's make it the people. So whoever wins, whoever, so between us, we pay.
Yes.
So a G-note each. So the bank is $2,000. So everybody knows. Okay. So either me or you are dishing $2,000 to one of our audience's favorite charities. So the ugly sweater competition wins. I don't care if it's the SPCA, if it's Sick Kids, if it's Veterans Hospital. Bang. That's how we do it.
I like it. Tell your friends. Guys, if you can do us a huge favor, I seen the comments. I do this on my phone, so it's a little tougher for me to see everyone's comments about how much they love these brunches. That really means the world to us. If you can just tell a friend about these brunches, how educational they are, send them the link, whatever. Like, we're not hard to find. I think you guys have come to realize that we're all over the place. And so we would love for you to just tell a friend about our brunch, a colleague, a neighbor, whatever it is, because we also want to bring more positivity, more education, more opportunities to more people. But we need your help to do that. So please tell a friend and get them onto the December 19th holiday special, where one of us are going to be spending $1,000. That's going to be interesting. I like that. $2,000. Okay, it's $2,000. One of us is going to be spending.
I was happy with $1,000. You're the one who upped the stakes.
Well, you know what? I'm in the hall. I'm in the festive mood. It's my favorite month of the year. So why? I
would appreciate if you bring it back down to 1,000.
We're doing 2,000.
You guys are committed now. There's no going back.
$2,000.
$2 G's it is.
$2,000 it is.
Fine.
Don't worry. Bobby did a refinance for $80K. We know who's buying us lunch coming up. That we know.
Okay, guys, I have to come on here. I want to say thank you, everyone. I don't know what is in everyone's coffee today. That's including the four of you, plus every single participant in the chats. I've never been more busy. Just message. I've been getting emails, text messages.
I know, Deb.
Private chats in the Zoom. Guys, I don't know what's in everyone's coffee, but this was such
I think
great brunch.
It's the month of December. It's the month that Jazzy was born in. So I think it has a lot to do with that. I'm all kidding aside, though. It really is. Look, I think it comes from a place of being so grateful and blessed. Simos and I started this a very, 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 very long time ago, 15 years ago now. And to have hundreds of people watch us on a Saturday morning at 10:30 is amazing. But first and foremost, to have someone like yourself, Tyler, and Bobby, and Laura, and Shemi, and our 39 real estate agents that are grinding every single day. It's why guys like Simos and I get to come on and put on this show and have the energy that we have, and we're so blessed. It's so easy for us to be so happy, and then obviously to have service providers and help like Chris De Souza's and the Michael Saraceni's and Scott McGilvery's, and the list goes on and on and on and on. And so thank you to everybody. And Tyler, you did an amazing job in the background. I know you're going to be busy till the end of the weekend, making sure that everyone gets in touch with Chris De Souza coming up, because we got a lot of stuff happening in the early part of 2021. So I want to make sure everyone's prepared financially.
Okay. Deborah Hicks, stop right now. She just threw it on the screen. Deborah Hicks, a beautiful and amazing, loyal, multi-transactional VIP client of ours who logs in all the way from the Pacific Coast every week, bar none. We just went through a hell ride. The developer was trying to play games. Lawyers are playing games. The game is the game. But then we did what we do. We said, hey, stop. Everybody, patience. You sit down. You sit down. You sit down. We go in. We go in. We go in. What happens at the end? We win. All it takes is patience. All it takes is strategy. Deborah, we have not received your amazing gift, and you shouldn't have, and I've told you shouldn't have, but that Dalwhinnie 15 is going to hit me in your stomach, boy.
Yeah. We love you, Debbie. We love you. And in closing, just thank you to everyone for giving us your time today and your patience as we go through these Zooms. We can't wait to obviously have you in the physical form in our offices back again. Tina, we love you too. And so to everyone, thank you.
Thank you, guys. Everybody enjoy your Saturday.